Now, adjusted trial balance. So in our last, lecture 4, we have talked about the trial balance, which is just a presentation of, the balance of the accounts. So rather, going to each ledger account and see the balance and then make the statements. So we just basically, this is not the financial statement, required financial statement. This is just uh, a statement which shows the balances of accounts. That's it. So what did we, studied over there? That it starts from the same accounting equation: assets is equal to liabilities plus owner's equity. So first we write the assets according to some order. And what order we call that? Liquidity. Okay, first we write current assets, then we write long-term assets. And then we write liabilities. Under liabilities, we write current liabilities, long-term liabilities. And then finally, we write down the accounts related to stockholders' equity. Right? So that would be unadjusted trial balance, because at the end of this period, we still need to see that how many prepaid accounts we have been, it has been consumed, how many accrued expenses are now due or we paid them, and how much is the depreciation. Then we write down all those adjustments here, and then we actually make income statement, balance sheet, and statement of retained earnings. So this is the example of adjusted and unadjusted trial balance. Here we go. So this line here. So this is the trial balance we have learned here. It has following some kind of liquidity order: first current, and then long-term assets, and then liabilities, then long-term liabilities, and then stockholder equity, and then at the end we have write it down the income statement account, expenses and sales and all the stuff, right? So what are the adjustments? These are just the entries that we just finished in our revision section. So you can post it here, or you can go to, this is just for your learning. You can go back to the previous slides and you can just see that where this 300 came from, where this 300 came from. Basically, these are all the adjustments that we just put it on our ledger. And these are the new balances. So you see some, let me change the color of the pen. So you see some balances are the same. For example, cash account is the same as like this. So it means cash account is not the adjusting account, so it doesn't need to be adjusted. Account receivable, yes, some customer paid us the cash. They need to be adjusted. Here we go. The new balance would be 2,500. So this balance directly, you can put it, or you can copy paste it through your T account of account receivable, right? So all the process is the same, just we adjusted the entries at the end of the period, like prepaid, unearned, accrued expenses, accrued revenue, right? And the last one would be the depreciation. When we account for all these adjusting transactions, then it's time to make income statement, and then statement of retained earning, and then balance sheet, and then cash flow statement, right? Let's move forward. Now we have the illustration here. So let's do that. So we have Phonics equipment rentals, which face the following situation. So we need to journalize the adjusting entries. We have given the date at December 31st, 2014 for each situations. So number one, the business has interest expense of 1,200 that it must pay early in 2015 January. So where you are standing right now, you are standing on 31st of December 2014. So what would be the entry on 31st of December? So did you pay that one? No. But this interest expense belongs to 2015 or 2014. Remember our matching principle. So if expense that belongs to 2014 should appear in the financial statements of 2014, right? So it means this is expense of 2014. So it should be written in 2014, or it belongs to 2014, matching principle. So entry would be interest expense to interest payable, right? Payable will go to balance sheet, but expense will go to income statement of what? 2014, right? Everybody understand that? Please, you need to let me know that you understand that. Nam, Pinyo, Harry, Anthony, Marilyn, Ella. Understand?
Yes.
Yeah.
Okay. Now, answer this question. The unadjusted balance of the supplies account is 3,200. The total cost of supplies on hand is 1,500. What does it mean? It means at the start of the year, we have the balance 3,200, and at the end of the year, we have the balance 1,500. It means how much supplies we have consumed. 3,200 minus 1,500. How much is the answer? 1,700. So what is the entry? So this 1,700 worth of supplies we have consumed in 2014. Consumed mean this is going to be expense. What is the entry? Supplies expense to supplies. Let me clear this mess here. Here we go. Supplies expense to supplies. Right? Let's move forward. Now, salary expense is $7,000 per day, Monday through Friday, right? Per day. And the business pays employees each Friday, right? Each Friday. Now, this year, December 31st, which is our recording date, it falls on Wednesday. What does it mean? Till Wednesday, how much salary is accrued, or how much salary belongs to 2014? Monday, Tuesday, Wednesday. 3 days salaries belongs to 2014. And Thursday, Friday, salary belongs to 2015. And right now, where we are standing? We are standing at 2014, 31st December. Right? So it means this salary is going to be expensed in 2014. So this 3 day salary will go to income statement of 2014. Right? So entry would be salary expense to salary payable. So did we pay the salary? No, we will pay on Friday, right? But the salary should belong to 2014. So we record it as an expense in 2014. Right, everyone? So that's why we expense it. So this will go to income statement and this will go to balance sheet. Right, everyone? Guys, I need your participation. Please unmute your microphone.
Yes, so far I quite understand.
Good, 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 good. Can you understand that?
Yeah, yes, sir.
Good. Well done. So if you understand that, please answer this question. So I'm going to give you 5 minutes to answer this question. So let me read that. For those who are watching online, so just pause the video and try to answer, try to make the journal entry here. On July 1st, 2014, when the business collected 15,000 rent, so first of all, you need to remember that where you are standing. You are standing at 2014, right? And now on July 1st, 2014, when the business collected 15,000 rent in advance, they make the entry as rent in advance debited cash and credited unearned rent, right? So they make this entry.